The Refinance Breakdown, episode 1 of 3. This is a series where I run actual numbers on actual refinance scenarios because the general advice you get online is fine, but it does not tell you what your decision is actually worth. Today, we're going to do a rate and term, meaning you have a loan at a higher rate, the rates have come down, and you want to know if it makes sense to refinance. Most people think the answer is just about the monthly payment, but it is not. There are actually several layers of this decision, and by the time we're done today, you will understand all of them. Quick note before we get into the numbers. Everything I'm showing you today is a conventional loan scenario. Government-backed programs like FHA, VA, and USDA have their own rate structures and their own refinance options. If your loan is one of those, the math is a little different, and frankly, in some cases, it's even more compelling. But that's going to be a separate episode. So let's get into the spreadsheet. I'm going to pull that up for you. This is the Refinance Decision Toolkit, and I'm going to put a link in the description so you can download it and run your own numbers after we're all done. Here's the scenario that we're going to work with today. You have a loan balance of $485,000 and a current interest rate of 7.25%, and your loan was a 30-year conventional loan originated in January of 2023. You've got 30 payments that you've already made, so you've got 27 and a half years remaining on this particular loan. And your monthly principal and interest payment right now is $3,309 a month. And here's the number I want you to hold on to. $606,823 is the total interest remaining on the loan if you don't do anything. On a loan that started at $485,000, that is the cost of doing nothing. So now we're going to move on to Scenario A in Layer 1. Scenario A is a refinance into a new 30-year loan with a rate of 6.25%. That rate is what most borrowers with a strong credit can access right now through a wholesale mortgage broker on about $10,000 in closing costs, and that comes out to an APR of roughly 6.41%. Your new monthly payment on that would be $2,986. That gives you a monthly savings of $322. That is Layer 1. That is the number most people stop at, and I get it. $322 a month is real money. Break even on closing costs, and that savings takes 13.8 months to equal your closing costs. So if you plan on being in the home for more than 14 months, this refinance already makes sense. But watch what happens when we look at Layer 2. The total interest on the new loan, on the 30-year loan, is $590,042. The interest saved versus your current loan is $16,781. Now, I know what you're thinking. It feels small for a refinance, and you're right. And here's the honest reason why. When you refinance from a 27.5-year remaining loan into a 30-year loan, you're extending the amortization clock. The lower rate saves you money, but the longer term takes some of it back. That's the part that most loan officers don't explain because it's uncomfortable. But I'm telling you now. Now, that's Layer 2. Layer 2 baseline is $16,781, but Layer 3 completely changes the story. So this is your Layer 3 section. Here's the question. You're saving $322 a month, but what if you didn't spend it? What if every month, instead of that $322 a month going into your pocket or into your budget, it went straight to principal on the new loan? Your total monthly outlay still stays the same, $3,309 a month, because you're paying the new lower payment plus the $322 that you were already spending. You don't feel the change, but look what happens. The loan is gone in 23.1 years, not 30. Additional interest saved, $156,000, $795. Total savings versus staying put, that's the combination of the interest saved for the closing cost as well as the paying it off early, is over $173,000. That is what I mean when I say be a good banker. A bank makes money by collecting interest over time. Every dollar of principal you pay takes that opportunity away from them and puts it back in your pocket. The mechanism is simple. Most people just have never had it explained to them. One honest note on those APR numbers I just gave you, they assume that you keep the loan exactly as written for the full term, with about $10,000 in closing cost. But the second you start adding principal, like the strategy we just talked about, you're changing the real cost of your credit. So that published APR no longer describes your loan. That is a win for you. Just know that the APR loses all accuracy the moment you make one extra payment. I guess you need to do a video on that one too. And now let me show you scenario B. Same starting loan. This time we're going from a 30-year to a 15-year loan at 5.75 interest rate. So this is where your scenario B comes into play. On the same roughly $10,000 in closing cost, that works out to an annual percentage rate of roughly 6.40. The APR sits a little bit different than the rate because those costs are spread over 15 years instead of 30. Now, the new monthly payment is $4,027, an increase of $719 per month. I'm not going to soften that number. If cash flow is tight, scenario B is not your move. But watch the interest. Total interest on that 15-year loan is $239,948. Interest saved versus the original loan, $366,875, and the loan is gone in 15 years. So here's where we land. Scenario A, the payment drops $322 a month. Apply it as principal and save over $173,000, and the loan is done in 23 years. Scenario B, the payment goes up $719 a month, but the loan is gone in 15 years and the interest saved is over $360,000. Neither scenario is wrong. They serve different goals. Scenario A serves cash flow and long-term wealth building through discipline. Scenario B serves equity acceleration and total cost elimination. But which one fits depends on where you are financially right now. That is the full picture. 3 layers, real numbers, no mystery. The toolkit I use today is a free link in the description below. In the first comments, you can find it as well. Plug in your balance and your current rate and run your own scenario before you call anyone. And when you're ready to see what the actual rate looks like for your specific profile, that is where we come in. We work with multiple wholesale lenders, which means I can show you real pricing across the market for your loan, not one number from one company. The calendar link is in the description. Come with your numbers and we'll bring ours. This is episode 1 of a refinance breakdown. Episode 2 is cash out, and episode 3 is debt consolidation. And episode 4 is removing mortgage insurance. Subscribe so you don't miss any of them. I'm Toni Taylor with Interconnect Mortgage.